Hello everyone. In this video, we'll be learning about India's foreign trade policy and how it has evolved over the years. Before we go into the specifics of Indian trade policy, let us understand what kind of trade policies can a country have, what are the options. Only then can we be able to understand what India has done over the years, because we have kind of gone through the entire spectrum of trade policies that are possible. There are three kinds of prevalent trade policies majorly. One is import substituting industrialization, second is trade liberalization, and the third is export oriented industrialization. So let's start with import substituting industrialization. This basically is the infant industry argument, which says that when a country is initially industrializing, it cannot compete with the well-established industries. So we need to temporarily support our industries so that they can grow up and become industries which can then compete in the world, and then they will not require any sort of protections. Hence we protect our industries and impose controls like import substitution. We put in high tariff barriers so that any imports coming into our country become much more expensive than the goods produced within the country because of the tariffs. So this was adopted by many low and middle income countries before the 1980s. Like I said, it was aimed to encourage domestic industries by limiting competing imports. And the basically prevalent belief at that time was that the rich countries would exploit the poor through trade if we did not protect our industries. But basically what happened? It was later seen that the countries which had no controls, like the graph in blue, grew better than the ones which had controls. So there was a big question mark on the validity of the argument itself. The basic premise of the infant industry argument was that the infant would eventually grow up to be an adult which would not require any more support. But what was seen in many countries was that this transition never happened, and the industries became basically people on crutches who always required the support from the government and were never able to stand up on their feet. Also, to support this whole infrastructure, the government was required to impose a lot of regulations, guidelines, because of which there was a high compliance cost. So another thing which would happen obviously is that if you are an industry which is using imported inputs, even though you might be producing for export or domestic consumption, you require an input which is imported. Now you also would be bearing the cost of the import barriers. So which is not really fair, because you eventually would have exported, so your growth as an industry is also limited because of the imports which are curtailed by the government. Also this led to inefficiently small industries in the countries. The second trade policy was trade liberalization. So what was the case for free trade? So this basically meant that the government did not interfere in the business and the trade policy and left the businesses to do trade on their own. The basic premises for this was that there is no market distortion, and if by the government, so there will be an efficient allocation. This is the basic, very classical free trade argument, free trade and free business argument, which says the invisible hands of the market will lead to efficient allocation of resources if there is no interference from any external player like the government. The second case of free trade was that because we are not imposing any restrictions on the companies, the economies of scale would kick in, and hence we would have the sizes of the companies would be optimal so as to exploit the economies of scale. Because there is competition in the market economies, there were a lot of opportunities for innovation, and the competition would not be curtailed by undue government interference. Another argument, which is not necessarily economic but more social or political, was that once you start giving SOPs to a particular sector, pressure groups develop, and then they try to lobby for various SOPs for their own interest group. So for instance, if you're giving SOPs to the auto industry, they would then develop into a pressure group and would make sure that the SOPs are continued even when they are not required. So let us assume that there was a world, because we really don't know, these are still issues of experimentation, but let us say there was a case that if the government interfered, it could lead to a better outcome than free market. But that would assume that the government is acting without any pressures, which is not always true. and always pressure groups will develop, which will lead to manipulation of the government, which implies that the government will not be able to work in the best interest of the nation and the businesses. The two arguments against free trade at that time were that there could be an optimum tariff. There are some certain economic theories which say that there is a certain optimum tariff that maximizes national welfare. Also, in many cases, domestic market failures may exist, in which case free trade would become suboptimal, and to correct those market failures, the government needs to interfere. So this was the debate at that time, but many countries went in for free trade and actually benefit a lot by using the free trade policy. The third kind of trade policy is export-oriented industrialization. This was followed in East Asia, China, and even Britain in pre-independence India. So what this meant was these countries promoted exports in targeted industries, and there were controls. So this is not free trade. So for example, export subsidies for import competing industries and export industries. So when there's a company which is trying to compete with an incoming import, the government would try to give it swap so that it can compete better. So this is not free trade. The government is not leaving the companies to work on their own in their own self-interest. It is actually giving a helping hand to the companies. Similarly, subsidized loans for industries, subsidized R&D. East Asia went in for a lot of these subsidized loans to selected industries and sectors. And also China's classic case of devalued currency. So China developed its industry so that it could focus on exports, but at the same time, like I said, it was not free trade because it was distorting trade by keeping an artificially undervalued currency, as many experts say. I'm not getting into the merits of that argument right now. Now, what has been India's trade policy? India's trade policy has followed three phases till now, as propounded by Arvind Panagria. From 1950 to 75 was rising protectionism, culminating in virtual autarky. So this can be called the infant industry, and like I said, import substituting industrialization, the first case that we discussed. Then we went on for phased liberalization from 76 to 91, and after 91-92 there was a more systematic liberalization and a definite move towards free trade. Now 2014 is the latest phase, which we're talking about Make in India, and we'll see about all these phases in some slight detail now. So protectionism, why did we go in for protectionism? One was, like I said, the classic infant industry argument are when at independence, we did not really have an industry to speak of. A lot of our industries, like the textile industries, had been quite devastated by the colonial rule. So we needed to develop our industries in order to gain our share, gain our reputation back as an industrialized nation. So at that time, the thinking amongst the policymakers was that we do need to support our industries if they were to be able to stand on their feet again. Also, there was a BOP crisis right in the beginning in 1956-57, which meant that we really did not have the FX, the foreign exchange, to sustain ourselves. So the policymakers at that point thought that we do need to stop the imports, otherwise our foreign exchange reserves will not be able to support our future needs. Also, there were a set of economists, especially headed by Nooks, who said that there was export pessimism. That is, India at that point of time was majorly producing agricultural commodities, and they said agricultural commodities by their very nature cannot really grow in exports, because if let us say even you as an individual, if you eat a certain amount of wheat or rotis in a day, there is only a limit up to which you will increase your consumption of rotis. You could keep on buying new, let's say, gadgets or other new consumption items, but agricultural commodities have a nature that they will be satiated beyond a given point. Also, the demand of those was fairly inelastic. So which that meant was that even if the price of the roti increases a little bit or decreases a little bit, you will still be probably consuming the same number of rotis. So because of which they felt that no matter what the developing countries did, they will never be able to really gain a high share in exports only on the back of agricultural commodities. So they said, because you cannot export that much with your current portfolio, you should rather stop or limit your imports and diversify your export basket by bringing in manufactured products, and then later you open up your imports, which at that time made a lot of sense to the policymakers. Also, there was no food self-sufficiency. Today we are self-sufficient in our food grains, but at that time we needed to import food grains, which again needed foreign exchange. And the thinking then was that if the foreign exchange falls short, you can cut down on other goods, you can cut down on a lot of things, but you cannot cut down on food. So we needed to conserve foreign exchange so that there is no famine kind of crisis at a later stage in India. So these are the reasons why we got into the protectionism phase in the first place. But what did it lead to? It led to inefficiencies, it led to controls, it led to Babu Raj and out of hand bureaucracy and a lot of corruption. Also, one technical point was that the policy makers underestimated the FX demand of import substitution. So while they said in the long run, once we can substitute our import with domestic production, we will require less foreign exchange. So let's say you were importing a car, so it would require certain foreign exchange. But if you are able to make that car in India itself, in the later stages, you will not that money will not go out of India, so you will not require those dollars. But what they did not see or foresee was that to make that car in India, you would require machinery which is not present in India. So you need to import that machinery. You need technology which was not present in India. Again, you need to import that technology. So the short-term FX demand really shot up. Another thing is the FX demand for consumer goods is actually lower than FX demand for producer goods. So if had we imported, let us say, some cars, it would, let us say, require $100. But to manufacture those cars, you need a machine, a big machine, which would require $1,000. So right now, in the short term, today itself, I require to shell out $1,000 so that I can save up on the outgoing $100, which was to come at a later stage. So which was a good strategy had we been able to utilize those making machines in a good way, in an efficient way, which unfortunately, because of the previous things that I mentioned, the inefficiencies, controls, etc., did not happen. So basically, there was a lot of problem in India. There were major BOP crises and major other kind of crises, which led then to the second phase, which is phase liberalization, which is in the middle of the 1970s. What happened that time was that some industries had started developing, and there was a demand from them to open up the economies because they were facing major problems in further expansion. Also, there was pressure from World Bank and from other countries to open up the economy. Also, at that time, even though our exports weren't that much, but we were in a relatively comfortable BOP, that is balance of payment position, due to remittances. So we got a lot of remittances from the Gulf, and at that time we felt that if we need to unshackle the economy from the clutches of these trade controls, if we want the economy to grow, and at that time we felt that we do have a sufficient reserve of foreign exchange and we will not see any problem in case the imports increased to a relatively higher level. Hence we went in for the phase liberalization. But then came the 1991 crisis. It was a balance of payment crisis in 91 which pushed the country to near bankruptcy. Now why did this happen? There were certain factors which were at play, which probably did not even have that much to do with India. First was the collapse of USSR. USSR was a major trade partner for India, and it was a major destination for our exports and also a source of our imports. Once that collapsed, our meager export earnings really collapsed. Another thing which happened in 91 was the Gulf crisis, because of which the remittances that I talked about, which were coming into India and making India in a relatively comfortable BOP position, again collapsed. So the remittances really dropped down, because of which we could no longer finance our imports, which because of the phase liberalization that I talked about, were now at a relatively higher level. So what happened was India could barely finance 3 weeks worth of imports. There were no FDI and FII investments in India because of, again, all these, the world was in a turmoil, and really people thought that the safest destination at that time was the US, and these investments that were earlier coming in, trickling in at least, completely stopped. So at that time the rupee was devalued and economic reforms were really forced upon India, because at that point of time we really did not have a choice. So after 91-92 we went in for an open trade kind of a system where the custom duties were reduced, the tariffs were reduced, a lot of controls which were there on various trades was removed. This is a subject matter of another video or maybe an update later. This is just to show you how our India's share in the world export has moved. This is to again show you the 3 phases that I was talking about. In 1945, India's share in world export was at 2%. in 1980s, because we were following a closed policy approach where we were trying to curtail imports, because of which exports also suffered, these export percentage actually dropped to just 0.5%. After that, liberalization happened in 92 and the exports went up to roughly about 0.8% in 2002, and now in 2014 they reached up to a high level of 1.7. Again, you can see that we have still not caught up with the levels of 1945. Okay, so now what is it that we're looking at right now today in 2015, but starting from 2014? So what are the possibilities now? Now these, what I talked about right now, the three kind of trade policies are the broad spectrum, but any country can decide to lie anywhere on that spectrum. It could be a mix of one or more policies. We can have basically a combination that fits us well. So one is we can go for export oriented industrialization like China, East Asia, which would require controls. That is we could have certain specific SOPs given to certain sectors, saying that, let us say we want to focus on the automobile industry or the pharmaceutical industry, and the government tries to give them support. Second is strengthen economic diplomacy. So we have more FTAs, more PTAs, and Mr. Modi going around the world to pitch India to investors and to also sign various agreements is a sign for this. Third is, which has been going on for a while, is export oriented service delivery, in which case India becomes the back office of the world, and we, like China is called the manufacturing hub of the world, we try to take care of all that service delivery, including tourism and other various sectors. But Make in India is really advocating a completely different approach from all these. So till now, like I said, you might have got a feeling, but I'll now put it in specific words, is that foreign trade policy was really de-linked from the domestic industrialization ecosystem. What that meant was, in terms of foreign trade policy, we would, let us say, have a SOP for an industry. That if you, let us say we give a SOP to pharma industry saying that, okay, you are a sunrise industry, so we give you, let us say, duty, so we reduce the duty or export duty on your products, or we increase the import tariffs on your substitutes. So that is a foreign trade policy. But we were not really focusing on what they require in India, what infrastructure they require in India, what kind of control reduction do they require in India. So because of this delinking, there was not too much focus on the domestic industrialization ecosystem. But what Make in India now is advocating is an ecosystem for manufacturing with special focus on exports. So while we are saying is that if a country needs to export, it first needs to manufacture at a very efficient level. Now that efficient manufacturing can only come in once the ecosystem in the entire country is geared towards manufacturing or business in general. So what all would that entail? That will entail restructuring your processes. You need to put in the right infrastructure, and also you need to focus on the right sectors. Details about these can be found in another video of ours titled Make in India, so I will not get into detail here. But what I need you to understand is that we are not trying to focus on exports in a silo kind of a system. We need to make sure that we improve the entire ecosystem so that exports automatically improve. Before thanking you, I would just like to say that India's export policy or the foreign trade policy is right now in kind of a turmoil, and we really need to see where the policy makers take it from here on. And we're still waiting for clarity from the policy makers as to what steps they're going to take to really, like Mr. Modi says, make the world come to India and make in India. We'll be keep posting you on updates on that. Thank you for watching the video. Hope you liked it. Your comments and suggestions are welcome. Thank you.